Hi, everybody. Welcome back to Friday Reading Club. Today, it is my privilege to be joined by Christopher Holtby of Wealth Advisors Trust Company. So thanks for joining us, Christopher.
Hey, morning, Griffin.
Really, what we're looking at today is an article from the Investments and Wealth Monitor by Mr. Holtby, exploring the dynamics and the differences between a family trustee and an advisor-focused trust company. So rolling into this to set the stage, a lot of you out there may be used to kind of the binary dynamic that when it comes to choosing a trustee or a fiduciary, that often you're operating at two extreme ends of a spectrum. One is a family member or friend, and the other being a bank or professional trust company that is usually tied to some larger nationally chartered financial institution. And obviously, there are solutions in the middle, but those solutions tend to not be well defined. And Christopher, did I set a good stage there for everybody?
You know, I go back to the kid's tale of Goldilocks and the Three Bears. Advisors, whatever they're helping their clients solve their problems, are always looking for that Goldilocks solution.
Yep. And I have a feeling that as attorneys are pushing for clients to get things signed and or advisors are encouraging clients to move forward, one of the biggest gaps often left open and keeping a person from moving ahead in their estate plan is the choice of a trustee. In fact, I'd be curious to see how high the stack would be if you could take all the pending estate planning documents prepared nationwide but not yet signed and print them and stack them up while they're waiting for this decision to be made. So in your article, you present the idea of the advisor focused trust company. So maybe explain a little bit more about that, about the functions and how those are split out and how that creates that Goldilocks type of solution that you presented.
So here's what's interesting. Any trustee, traditional family advisor friendly like us, any trustee can only do four things: onboard a trust, do a tax return, make distributions, do investments. That's it. Like that's all a trustee can do. Now, we don't custody money, we don't invest the money, right? We just sign tax returns and make distributions. When I sat in those meetings with clients, because I was an advisor for 15 years, at E&Y and then later on independently, the greatest conversation: who's going to be my guardian? How are my kids going to enjoy the money? And who is going to be the trustee? And literally, the attorney goes, well, I have a friend down the street at blah, blah, blah. Okay, great. Done. That's the conversation. When the families choose an individual, what they really want, and this is why I wrote the article, they want context around the distributions. They don't want them to do all the work. They don't even know all the work that's going to be having to be done, but they want the context. And they don't know that a Goldilocks solution exists. And the attorneys don't know that we exist. The advisor, all advisors listen to this, I beg you, please, please attend that first initial estate planning meeting. If you don't, you will be seen as less than, not as a thought leader, and you will eventually be disregarded as an important part of your client's life. I don't know when, I don't know how, but I've got 30 years of data to prove it. So please just show up for the first one. So Griffin, to your point, when you're dealing with smaller estates like below 3-ish, 4-ish million, and it's all qualified money, retirement IRA money, family trustee is a great option. Once you're dealing with 6, 8, $10 million non-qualified money and you've got unique assets, that's when you've got to look at, okay, how do I create guardrails around what I want? And the advisor should be there because the clients want some sort of consistency of the legacy between generations, and the advisors can deliver that, not the attorneys. The advisor can. So
That's a really
that's
good
how I would
point.
answer the question.
Yeah, and I think there's a lot of I guess mismatch between the attorney world and the advisor world when we look at net worth versus what assets can actually be managed. And that's a subject that warrants its own discussion of how do you break down those net worth bands to really align with this type of choice and this type of presentation. And you brought up the attorney saying, "Oh, I've got a buddy down the street." I don't know if your experience aligns with mine. I have so many situations where I've gone in with a client and looked at their documents and it says, "Oh, you have insert name of bank inserted here as trustee. Was that intentional?" "No, I didn't even know they were there. How did that happen?" I'm like, bold move there, sticking in the random bank as a backup contingent trustee without the client's consent. But you raise a good point that, yeah, everybody has to be on board, and who watches the watchman at the end of the day. But again, in the broader scheme of things, you really did a good job in the article raising some hypotheticals. One being first the elderly gentleman who's trying to get a final set of documents buttoned up and just cannot figure out or move ahead on that executor or trustee choice. So maybe explain a little bit more about how the advisor focused trust company would come into play there as a solution, maybe as a co-trustee or in a primary type of spot.
So if you really think about what any trust company is really, really good at, is making the hard decisions of discretionary distributions, which means, who gets what, why, when, and how. And those can be really emotionally charged. And you got this trust company having to look at this language and say, what did John really want, or what did Mary really want us to decide on? So where trust companies are not good at is acting as a custodian or managing the money. So it's really weird. If Northern Trust was really, really smart, they'd be like, yeah, we're not going to manage money. We're just going to do the administration. And to be honest with you, they would crush it. They would be awesome at it. But thankfully, they think they can do it all. So that leaves wide open opportunities for advisors to take business away from them. Separate type of podcast. But the most important part, again, is in this one particular example, the advisor just goes, look, what is the most important things emotionally? And he used the word emotionally because all of us, well, I'm guilty of it, we justify with logic, but we start with emotion, even engineers. And I know some crazy engineers, and they're all like, yeah, okay, I admit it. So even they admit it. When working with clients, you want to separate what they want done. And it's really important. And attorneys, not all attorneys are good at this, Griffin, you know this. Adding removal language for a corporate trustee. You want someone to be able to fire us. And that holds us accountable. And humans do great when we're held accountable. It spurs us to do awesome things, like to create the round wheel versus no wheel, right? So accountability is super. So I'll pass that along. But that was the main thing for this particular advisor and the individual was what are the emotions driving their pain?
Yep. And emotion is a dirty word for a lot of attorneys that they're like, "Oh, make an emotional connection with the client. Oh, I don't want to do that. Let's just get the documents done and move along." But that issue aside, on the human side of planning, you brought up a very interesting case study after that too, where you and I first connected was around this, kind of loose idea that we have the wealth tsunami coming up. Tons of wealth is going to be transferred, and anybody who's visited an estate planning attorney with a pulse in the last couple of decades has some sort of plan that is probably going to put wealth into generational trusts for their children, descendants, so on and so forth. And as they start to inherit this wealth, emotion is going to be an issue too, but also what they're going to find in the face of that emotion is some bank trustee with a lot of red tape that needs to be satisfied in order to receive distributions from the trust, not to mention a lack of transparency and several layers of bureaucracy to go through to get basic information about their trust. And in the article, you present the advisor focused trust company as a possible solution for the beneficiary who, like many, has that power you alluded to remove the trustee and possibly replace them, maybe with some bounds around it being a quote unquote corporate trustee or maybe any trustee under the sun. So maybe dive into that a little bit deeper and explain how you approach that type of problem and how the solution is a little broader than what is often anticipated in the general marketplace.
So yesterday, I'm in LA today, or this week, and I met with one independent advisor firm. They run about 6 billion here. And one of their new employees came from Wells Fargo Trust Company. And she goes, okay, how do you deal with affordability, accountability, and transparency? So transparency, I haven't heard that word before. And what she was talking about, Griffin, is transparency around discretionary distributions. And what I explained to her is that I'm going to get a little bit geekish, so pardon me.
Now
But
dive
within a
in.
trust document, right, there's net income, straightforward. And then there is discretionary distributions, which means we, the corporate trustee, gets to decide who gets what, when, why, and how. There's a way to increase the transparency. So if you look at most clients, you've got qualified money, non-qualified money, operating assets, and then trust assets. The only person who understands those 4 asset locations is the advisor. And so what the advisor does with their holistic plan is they know, okay, what do we need to live on for multiple years or generationally, right? Tied to what each of the underlying assets are, the tax situations, because they're talking with the CPAs, they know how all the moving pieces. So what we do for transparency for the beneficiary is we say, look, what's the financial plan? So the advisor and the trust officers say, look, this is what the trust document legally allows. This is what the advisor goes, the client needs. Here's what we need the trust to deliver. Collaboratively, how do those two things work together? And she went, is that it? I'm like, yeah, dude, it's not complicated. And what happens in a bank, same client, right? But the problem in the bank, and I won't say which one, but they're all the same, it is you got the trust department that's a separate regulatory entity with a separate P&L. You've got the non-bank trust side, separate regulatory P&L. You got the poor relationship manager. You got these two sides fighting with one another. Who controls the client and where the money coming from? Relationship manager is like overwhelmed, sitting on the Titanic, confused. Wait, which other iceberg's going to hit me today? Oh my God. And the client goes, can I just get someone to call me back? But with an advisor, you've got one thought leader who can coordinate it all together, nice and neat and organized. And so when I explained to her, she goes, I get it. And that's how you deal with transparency in discretionary distributions, is there has to be one thought leader who sees the whole picture. And as the corporate trustee, yes, we own the assets, but we know we only see a very narrow sliver of the beneficiary's whole entire financial picture.
That is a really good point. And then in the broader scheme of things, when we're looking at choice of trustee, a common friction is, okay, if you have investable assets publicly traded, yeah, trustees will eat that up. Yet you become like a leper the minute you have any sort of closely held business interest or farmland or real estate, or now even in modern times, cryptocurrency or alternative investments. How might an advisor focused trust company be a little bit different in that approach where perhaps you're no longer a leper if that is indeed your asset mix?
Um, as I write in the article, really any trustee is only worried about risk and time. Old trust companies are worried about control, and we know who they are. From an advisor's perspective, really from the client's perspective, what you do is you take those unique assets, you put them into a manager managed LLC, and you allow a trust protector, and that's just really a term, someone that can have various powers. So a trust protector can appoint the manager of the LLC. And then what that happens is that means that the risk of the trustee goes down. That means the fees go down. And then really the family is going to have someone who knows how to manage that property the best, whether they hire it out or do it internally. A traditional trust company doesn't know how to manage 4 buildings in downtown Boston better than the family. They just don't know how to do that. So again, in history, we know you build on your strengths, you hedge your weaknesses.
Excellent. Well, for any advisor or attorney out there who wants to explore this concept a little more and would like somebody to kind of bounce ideas off of, how can they reach you, and where can you be found?
I think the easiest one would be LinkedIn, or you could look for Christopher Holtby. But at the end of the day, advisors want to offer a Goldilocks corporate trustee solution to clients, and they can reach out to you. They know you. A lot of them use you already for all sorts of services. So that would probably be the easiest thing for them. And then that's it. So yeah, look, there's $4.5 trillion in bank trust assets. All that money they can go after, but that's another podcast.
Good point, and a good way to end this. So appreciate you coming on, Christopher. I'll link all your information below, including your Investments and Wealth Monitor article. But I
Oh, great.
appreciate your time today, and thanks for educating us on advisor-focused trust companies.
That's I love it. Anytime. Thanks, Griffin, for having me on. I really appreciate it.